Good afternoon and welcome everyone. We are here for media briefing of Q1 2020. We will go with our regular format. First, our CFO and whole-time director, R. Shankaraman sir, will present the numbers to you. And after that, there will be question and answer series with RSR sir and our CEO and MD, Mr. Subramanian. So over to RSR sir.
By default, you gave a promotion to. Good afternoon, everybody. Thanks for being here. A few things up front before we get into the results of the quarter. This quarter has been significant from a couple of points. One was we got the approval of Competition Commission of India for divestment of electrical business. And that's a big formal step that has been crossed for us to work towards consummation of the transaction. So according to the accounting standards, any such business which is held for sale needs to be disclosed as discontinued business, and the results of the business will be just reflected as a single line item as profits from discontinued operations, and it will not have any other presence in the financial statements in terms of revenues, costs, etc. So the numbers that we will be presenting to you are excluding at all levels other than PAT the operations of electrical business. Secondly, this quarter also saw us complete the open offer for Mindtree, and we completed the process, and we have today owners of 60.6% shares of Mindtree. So that's another significant event that happened in the quarter. And the third event is for our L&T Technology Services, a listed company in the space of engineering services. We had to achieve the targeted minimum public shareholding of 25% 3 years from listing. And the 3 years were coming to an end later this year. So we, during the quarter ended June, completed the divestments to reach that 25% public holding threshold. So all three things were significant events, and we have completed. While doing all of this, we also managed to pay attention to our business, the engineering construction business, the projects business, manufacturing and services business, about which we will possibly see. Before we get into the results, I think the usual disclaimer about forward-looking statements that will be made in the course of the presentation and the conversation that follows the presentation. In terms of highlights, it's been one of the very stable quarters. We performed well and to plan on most of the parameters that we set ourselves for measuring the performance of the company. The fresh orders that we took increased by 11%. All of these are in comparison to quarter one of the previous year. The order book consequently rose by 9%. We are almost closing in on 3 lakh crore of order book. Revenues increased by 10%. EBITDA increased by 20%, which is good news because I think profitable growth is always important. So the revenue is growing by 10%, EBITDA growing by 20% is good signs. And consequently, the profit after tax has moved up by 21% year-on-year comparison for the first quarter. Starting from order inflow, during the quarter ended 30th June 2019, the company won orders worth 387 billion rupees, which is 11% growth over the 348 billion that we recorded as order wins during quarter one of the previous year. As you can see, 23% of the orders that we have won during quarter one came from international markets. And in comparison, year-on-year basis, the domestic orders that we won during quarter one of the previous year was 257 billion. We actually, during the course of the current year, first quarter, we won orders worth 297 billion rupees, which is a 15% growth on the domestic markets. The international markets have been flat, 91 billion rupees of the quarter one of the previous year, by and large remains a similar level during the quarter one of the current year. There have been some orders which have been deferred for award, which were actually targeted for quarter one, and they didn't come through, and we hope that they do materialize in quarter two or thereabouts. As far as domestic orders are concerned, the growth Actually, we are quite surprised that we could ramp up on domestic orders because this, as you know, was an election quarter. So we weren't very sure about the disruption that the electioneering process would set in terms of winning orders. But fortunately for us, I think the momentum that we carried in from the previous year, particularly the fourth quarter into the current quarter, enabled us to keep winning the orders, and credit to the agencies which gave these orders that they continued to persist with ordering out and moving forward on the programs. We won a large power EPC order after a long while and very sweetly beat BHEL to get the order, and it helped, along with some hydrocarbon orders from ONGC, it helped us clock better domestic order wins during the current quarter. The order book, as we see now, is 2.9 trillion rupees, which is a 9% growth over the 2.68 trillion that we were at June of 18. 62,000 crores worth of orders are from international markets, and they represent around 21% of the total order book. Much of the orders, as has been the pattern over the last few years, have come in from infrastructure segment. Of the 387 billion rupees worth of orders that we won, 45% came from infrastructure segment. Consequent to the order win in the power group, the contribution of power EPC for the order inflow increased to 17%. Hydrocarbon was at 8.9% based on the order wins of 3,500 crores during the quarter. We normally, for the purpose of statistics, since we are presenting the consolidated financials, do include the services income as order inflow, just to balance the math, and the services contribute to nearly 22% of the total order inflow. When it comes to order book composition, 75% of the order book is in the area of infrastructure. Out of the 2.9 trillion rupees, 2.18 trillion rupees are in infrastructure segment that will be executed over the next 3 to 4 years' time from now. Hydrocarbon has moved to 404 billion rupees, which is another large piece of order book that we are required to execute over the next couple of years. Power at 129 billion rupees and defense at 110 billion rupees constitute other significant portions of the order book that we have as of 30th June 2019. When it comes to financial performance, the revenue of the company for the quarter one under reporting is 296 billion rupees, which is 10% growth over the 270 billion rupees of the previous year. 31% of the revenues that the company has earned during the quarter comes from international orders, both exports as well as project orders. The manufacturing construction expenditure incurred by the company at 179 billion rupees for the quarter is up 9%. And the interest cost of the financial services business, which is regarded as an operating expenditure on par with the manufacturing, construction and core costs of bringing the revenue, is at 20 billion rupees, which is a 26% growth over the previous previous year's corresponding quarter. Staff cost is at 45 billion rupees, is up 10%. There's been staff augmentation in the services business, information technology business, engineering services business, as well as financial services business have increased the headcount, and over the period of last 1 year have added people. And particularly in the information technology and engineering services business, people are added on-site locally in the overseas markets, and hence they do contribute significantly to the cost escalation, and we do hope that those hires will help us churn out better revenues and better profits in the subsequent quarters. Sales and administration expenses at 17.5 billion rupees is down 12%. This is largely on account of lack of requirement to make any provisions for ECL and other purposes during the quarter as compared to the corresponding quarter of the previous year. Hence, the total operating expenditure as against the revenue of 296 billion rupees comes to about 263 billion rupees for the quarter. EBITDA consequently at 33 billion rupees is up 20%, and the EBITDA margin moves up by 100 basis points from 10.2% of the first quarter of the previous year to 11.2% of the current year. Other income at 3.8 billion rupees is up 69%. we were able to take advantage of the fact that the surpluses that the businesses collectively had as a group were deployed profitably in markets, in safe instruments, and hence they were able to generate a yield which gave the benefit of the other income. Interest cost at 5.9 billion rupees is up 61%, largely on account of the additional borrowing that the group did across its various businesses, largely as a result of liquidity buffer created to enable completion of transaction like Mindtree and potentially a buyback as and when the regulators would deem fit. Depreciation amortization at 4.6 billion rupees is lower as compared to the previous year, largely because the previous year had certain amortization which is no more required to be made in the current year. The exceptional item at 0.9 billion rupees is largely on account of impairment of equity investment in a road project as a part of IDPL portfolio, and there has been an admission by NCLT for insolvency proceedings of this road project, where we are not the majority holders, the banks are majority holders. The banks have moved the NCLT, and consequently, in recognition of that development, we have impaired the equity investments that we had more in terms of prudent accounting. The outcome of NCLT proceedings we will come to know in due course, but not wanting to wait for the outcome, we thought it is important that we recognize that this investment is impaired. But they are part of the exceptional item that we have. The discontinued operations represent the electrical business, the net profits earned by the business at 1.1 billion rupees as compared to 0.9 of the previous year. The business overall has done well. The revenues have grown by 6% and its margins have improved, and hence the profitability improvement of 31%. We will cover a bit of that in the subsequent segment section of this presentation. The reported profit after tax for the quarter for the group as a whole is 14.7 billion rupees, which is up 21% as compared to the 12.1 billion of the first quarter of the previous year. The segments are by and large the same, except that the electrical and automation segment, which is part of the core operating segment, will be moved to discontinued operations segment. So consequently, in the pecking order, they would come in last. Starting with infrastructure segment, the segment earned a revenue of 138 billion rupees, which is 14.3% higher than the 121 billion of the previous year. Based on the large order intake of the previous year, the segment has done well to move ahead on its execution plans. Out of the 138 billion rupees of revenue, international revenue are at 32 billion rupees, which is down by 14% as compared to the previous year, largely on account of closeout of several large international projects that the company has been executing over the last few years. The EBITDA margin at 6.4% statistically is 49 basis points lower than the corresponding period of the previous year, but this largely reflects the stage of execution of much of the orders that we have picked up during the later part of the last year, and consequently does not reflect the actual margins from the infrastructure segment going forward for the year. Power segment, the net revenue of the power segment is 5.6 billion rupees, almost down 50% as compared to the previous year, largely on account of depleting order book. During the last 1.5 to 2 years, we've been speaking about lack of orders for the power segment. Consequently, as the order book got executed and we were coming to the fag end of those projects, the revenues, as expected, were declining. Now that we've picked up a significant order during the current quarter, we do expect slowly over the subsequent quarters, maybe over the third, fourth quarter, the revenues will start picking up. And we do hope, looking at the pipeline of orders that are likely to come out from the segment, there could be an opportunity for us to participate in a couple of more bids, and let's see what the outcome has for us. Much of the international jobs that the Power Group was doing is in Bangladesh, and many of those jobs are coming to an end, and that's reflected by the income coming down from 3.5 billion of the previous year to 1.6 billion in the current year first quarter. The EBITDA margin at 3.3% again is reflective of the mix of the job and the stage of their execution, and hence statistically there is a 80 basis points reduction in this quarter as compared to the previous quarter. As the order intake increases and the execution picks up, these margins are expected to get back to more normal levels. Heavy engineering business had benefit of significant order wins in the previous year. Consequently, the segment is reporting one of the highest quarterly earnings at 8.7 billion rupees, which is 162% higher than the 3.3 billion of the first quarter earnings of the previous year. Much of that business is also meant for international markets, as you can see from the share of international revenue. 3.8 billion out of 8.7 is on account of international orders that we have won, and that is also growing on par with the overall income of the segment. The margins are reported at 19.5% for the quarter, as compared to 36.1% of the previous year's first quarter. In the previous year's first quarter, there were several jobs which were come to an end, where all the cost provisions that were no longer required were released into the accounting statements. Consequently, there is an elevated margin of 36.1%. And this happens whenever there is a bunch of jobs which get completed. These kind of unused cost contingencies get released. So to an extent, they don't represent the normal linear trend of margins. But notwithstanding that, margin at 19.5% is fairly healthy for a business where we have some unique capabilities, even on a global scale. Defense engineering segment, there's been growth in the revenue at 9.7 billion rupees, is up nearly 33% as compared to 7.3 of the previous year. Here again, there has been a bit of an international orders that we have won, largely on account of naval orders, which is at 0.4 billion as compared to 0.8 of the previous year. The EBITDA margin at 16.5%. It's a combination of improved efficiency in the defense and aerospace business that we run, and the job mix that is yielding these margins. The shipyard has not contributed significantly to these margins because they are still underwater in terms of ability to recover, and we're still waiting for the government to place significant orders that justify the investment of the top class yard that we have built. Hydrocarbon segment continues to have good run. We had revenue at 37 billion rupees for the quarter, which is 7.2% higher than the 35 billion of the previous year. Much of this, in fact, half of the revenue goes to international markets from orders that we win from there. So 18.5 billion is revenues from international market, pretty much at the same level as in the previous year. The margins have improved by 60 basis points from 7% to 7.6%. And the business is in good shape because the projects that we are currently executing are on schedule and are generating profits. And we also see a healthy pipeline of fresh orders in the Middle East and African markets. And the company will look at each of these on its merit and decide on participation. But the business is on sound footing. Information technology and technology services, these are two different companies listed, and you would have seen the results, but for a purpose of consolidated results, we segment them together and they form the IT and TS segment. The combined revenue of both the companies, L&T Infotech as well as L&T Technology Services, add to 38.2 billion rupees, which is 15% growth over the 33 billion rupees of the previous year. Much of this revenue comes naturally from international markets. US, Europe are large markets where these businesses participate. So 34.8 billion out of 38.2 billion is from international markets. The EBITDA at 23.2% is 1.5% lower, and in this quarter we had both the impact of local hiring as well as visa costs getting absorbed into the costs of the company, and hence we see a decline in the margin. We do believe that with subsequent quarters we should be able to get back to the original levels of margin, which is at least 1% higher. Financial services, very turbulent times, a lot of rumors and fears more than facts that plague the market. Liquidity is virtually dry, and financial services has to be positioned and perceived as exceptionally sound for it to have even a whiff of a chance of generating liquidity and to stay in the business. So consequently, in reflection of all of this environment, L&T Finance, which is L&T Financial Services Holding, which is actually a holding company of all the financial services business that we have and listed, has reported 34.6 billion rupees as revenue, which is 13% growth. The disbursements have come down by about 6% as compared to the previous year's first quarter, but the profitability has remained intact. Both the NIM and the fee income continues to be healthy. So, and more importantly, the recovery against NPA assets have also helped the company report a lower non-performing asset portfolio. Consequently, we see the pressure on liquidity and lower disbursement getting offset by lower credit provisioning. Consequently, the profit after tax for the company is at 3.5 billion rupees, a touch lower than the 3.6 of the previous year. These results also reflect two important developments. One is much of the ILFS portfolio exposure have got resolved, barring about 200 crores, which is pending resolution through the NCLT initiatives. So they all moved from amber category to green category. So I think much of the monkey of ILFS exposure off our back. And the second one was our exposure to a housing finance company. We had invested in some of the bonds issued by the company, and because of the lower credit rating received by the company, we have impaired the bonds by 50%. So consequently, the results that you see, which looks like flat PAT, is as a result of some of these initiatives. The developmental project business that we have as Hyderabad Metro and Nabha Power, all the toll roads that we own through IDPL is consolidated at the single bottom line effect and not on the revenue. So the revenue of 11.8 billion rupees that you see is largely on account of both Hyderabad Metro as well as Nabha. The 21% reduction that you see is due to the previous year's numbers, including the sale of Katupalli Port, which was completed in Q1 of the previous year. And the port is no more with us, and consequently that was one-off. The EBITDA margin at 10% is down by 20%, largely on account of the same reason. The profits on the divestment of Katupalli Port is no more as part of current portfolio, and hence this reflects normal operating margins. Hyderabad Metro, as the months go by during the current year, will get completely commissioned. We're almost at 95-96% of the completion, and the financials of 2021 will begin to reflect the performance of Hyderabad Metro. Other segment is a combination of the residuary businesses, construction equipment, mining business, the rubber processing machinery, as well as realty business and industrial valves. The segment has reported 11.5 billion rupees, down 14% as compared to 13.4 billion. The reduction is largely on account of realty business. In the previous year, there was a clutch of flats, apartments that were handed over to the customer according to the new accounting standards. Only when the possession is handed over and the title passes can you recognize it as income. So in the Q1 of the previous year, we had such an occasion to recognize income, which is not the case in the current quarter. But these are all timing of revenue recognition, nothing to do with the performance of the business per se. The EBITDA margin at 24% is down by 2% as compared to the previous year, largely on account of a similar mix of apartments that we are handing over. Just for record purposes, about 500 crores of revenue is from realty business, and all the rest of industrial products and machinery account for 650 crores of revenue for the quarter in question. The last segment, which is electrical automation, which has been discontinued operations in the context of its passage from L&T to Schneider. The revenue has grown by 6%, 13.6 billion rupees as compared to 12.8 of the previous year. The margins have improved, as I mentioned, I think both in terms of operational efficiency, product mix, and better realization in the marketplace. We've been able to improve the margin from 13.3 to 16.9%. And with this, we come to the end of the segment presentation and throw open for question and answers. Thank you.
So you completed Mighty deal this quarter. So can we expect some leadership change out there?
I think it's a question which is obvious because the executive chairman and the CEO have moved on, and therefore we'll have to find leadership. We have found the leadership. We'll announce it shortly.
Sir, as far as financials of Mindtree is concerned, sir, it has got a setback. So, sir, what are the steps you will take to mitigate that?
My dear friend, this is to announce our quarter results. Let's focus on that. That's another company. I would not like to comment on it, on L&T's performance. Maybe from next quarter onwards, when we are fully in control of the management, we can make the comment. And maybe the management, when it meets there and announces its result, will make the comment there. So let's restrict ourselves to L&T's overall quarterly
So,
results.
setback for you came from Bombay High Court as Bombay High Court cancelled the CRZ format for Coastal Road. So, what are the steps you will take in coming days?
It is a setback, and one needs to worry on this as to why such actions are being taken. Here is a project conceived by the government, all permits taken by the government, and we've been awarded the contract in a fair process, and then the matter goes to court through public interest litigations. The court has taken a particular view. Supreme Court has also taken a view on that. So logically, we'll go back to the government has to go back to the Supreme Court because we are only an impeding party therein. And let's see what happens after that. I think the matter is coming for hearing on Thursday or Friday. We'll see the results of that.
In terms of the orders, like Mr. Shankaraman said, that it was surprising that the orders was quite. That the order inflow was quite strong despite the elections. You did pick up a few big orders, especially in the power space. A couple of things. A, you mentioned the deferment of orders in the international market. Can you just give us a sense of what orders are this and how big can this be? And the other thing, in terms of the order pipeline now in the international market, given what's happening in the crude space and the tension in the energy market, the geopolitical tension, do you think the hydrocarbon sector could be directly impacted in terms of new investments?
So many questions you ask. I'm trying to.
Okay, we'll go one by one. First, if you can just give us a sense on the deferment of orders. Which are the orders that you were referring to?
National, you mean?
Yes.
Yeah, there are a few very major orders which we are well placed, and I think it's in process right now. We should be in a position to announce it shortly, and we will do that. There are a few orders in this is especially in Saudi Arabia, and that's what I think Shankar is referring to. It's in proper process and shape, and we should maybe could have got clicked in Q1. It got deferred to Q2 for various processing reasons, and we should be able to get that. That's what he meant.
Okay, so you think it will fructify in, second, third quarter?
Second quarter.
Second quarter. And in terms of the hydrocarbon segment, given what's happening, the geopolitical tension that is building up right now, do you foresee any impact right now, or what is your take on it?
See, predominantly, as we see the hydrocarbon business, the prospects that we see are in Saudi Arabia, to a certain extent in Kuwait, and to a minor extent in Qatar. Well, Qatar has been focusing on the 2022 FIFA games, and bulk of the spend, if at all, has gone on to building the infrastructure, the stadiums, the roads, the facilities, and such. But I think they're coming back to what you call redeveloping their gas fields and so on and so forth. We do see some prospects there, but predominantly it's Saudi Arabia. There are some major developments going on, and we have been the beneficiary of it in the past, and we'll be beneficiary of it in the future. We don't see any major disruptions therein, and it's let us say this, it's positive from that point of view.
In terms of the domestic market, what's the pipeline looking like right now? And obviously, this is a question we have been asking you for a few quarters now. But any green shoots in the private segment in terms of projects coming up, and with the debt resolution, moving forward now, do you think probably there's some visibility on when we can expect a recovery on that aspect?
In domestic market, I'd place my views on two different baskets, Rachita. Number one is on the orders. As we have seen the last 2 years, the last 2 to 3 years, the shift has been predominantly towards funding of, the funding has been predominantly from the government sector, both central government, public sectors, as well as the state governments. It will continue to be so, in my view, for another few years, at least another couple of years. And therefore, the dependency on the state to do necessary programs, capex, etc., is a must. we've had a fairly decent budget, but the budget has concentrated on a few aspects which I thought the government wanted to concentrate on. They needed to generate revenue. They just won a great election, and maybe their force and thrust was to collect revenue and thereby improve the overall positioning of the government finances before they go on major capex and so on and so forth. So having said that, we do see allocations on infrastructure, the talk about 3 other corridors of the dedicated freight, the initial inquiries on a high-speed corridor has started. The Sagarmala and such other programs are seeing the light of the day. We also see the Namami Ganga and such programs being given a thrust. Somewhat additional thrust with the formation of the Jal Shakti Ministry. I think the interlinking and water resources will gain further impetus from the government. There's continued thrust on this Atal mission, that is the rural electrification and such other programs which brought benefit to huge amounts of people. And so on and so forth. Now, how the overall budgetary guidelines will get down to deep dive spending, one has to see, but we are reasonably positive about such spending. The second part of your question is, I think, which is a little more worrying for me in the sense is that for the first time, we're seeing after a long time that when a regime change takes place in a state or elsewhere, you have the new regime coming and looking into matters of what the previous regime has done and taking serious views on it in terms of going slow on contracts, stopping contracts and such. I hope this initial way of looking at what the previous regime does is quickly got over with so that one can proceed with whatever obligation one has under contract. Because these are not something which we can understand. We go by what is signed as a contract and you proceed. But if further matters are looked into, it slows down the progress. It gets into all kinds of other kinds of analysis, etc., which is not best done. So there are a few contracts which are facing these problems. One hopes that one gets out of it to gain the total momentum. But otherwise, I feel generally positive about things. Yeah.
Just one question on the order book. With the coastal road issue now in the court, and just generally on the order book side, is there any categorization that you have done for this coastal road project? Has it been moved to slow-moving orders, or what is the extent of slow-moving orders?
See, let's look at the judgment in the coastal road. The judgment is very clear. It's asked the government to regularize the respective clearances they need to get to proceed with the project. In one of the projects, they got a particular approval. In another of the projects, they had not got it. So they told them, please regularize it and move forward. So one, the government in its right mind would appeal to the Supreme Court to set aside the judgment, if at all, to look at it from their perspective. But if the court also insists, look into the clearances and go forward, they need to apply for it and go forward. And that's a normal process of 2 to 3 months, and that should happen within that, unless there is some other way to look at it. Therefore, in my view, let's remain optimistic about it. As one of the recent articles where Shekhar Gupta says 4 square foot of coral stopping an entire coastal road, which is the future of Mumbai, in my view, is another way to look at it, and let's look at it from that point of view.
The point of supplementing that is, you see, it's in a way good that these things happen upfront in the project. So you don't commission yourself and get headlong into the project and then get stopped midway. So in a way, the silver lining in a dark cloud is that it has happened upfront. And secondly, I think when operating in public spaces, these kind of things have to be anticipated. And to some extent, the more marquee the projects are, the more activism will be around it. I think it's a question of conviction, and the governments will have to test their own conviction. And we do believe that other than setback to the plans, this has not happened at a very inconvenient time.
Hello, sir. This is Yash here from CNBC
Raise
TV
your hand
18.
up, I don't see who's talking. Okay.
This side. My question is with respect to the infrastructure segment margins. They've declined in the first quarter for this financial year. As far as the entire year is concerned, what do you expect on infrastructure margins? Do you expect an improvement, or do you expect them to remain flattish for the year?
See, I keep telling it in every conference, and so does Shankar keep repeating it. You can't judge infrastructure projects of 3 years, 4 years, quarter by quarter. It's possible one job we thought would get valued is coming for evaluation next quarter. It's possible that one job which we thought would progress faster is growing slow. It's possible that one job which had very great margins in the previous quarters is coming to an end. So don't take a very short-term view. It's better to judge it on a long-term view. The last year you had similar views. We delivered decent results. So another 3 quarters are there. Hope for the best.
We expect improvement. I mean, do you see the picture
I think we are
improving for
given
the
a
full year?
guidance. We are on it right now.
Okay.
Hello, sir. This is Ashwini from Bloomberg Quint. I would like to ask you for FY20, what would be your guidance for order book, revenue, and margin?
It looks like you missed the annual meet after the results. We have informed the market that the order inflow will grow by about 10 to 12%, and the revenues would grow by 12 to 15%, and we'll have stable margins.
Sir, Priyanka here from BTVI here. I just wanted to understand in terms of the order execution pace, in terms of any issues that your clients are facing considering the liquidity situation, and what are you understanding in terms of that? Are there any payment delays, etc., happening? And yeah, I mean,
It's a very good question that you asked. So I think there is a payment cycle that's happening. There is a tightening of fists from both the government side and, of course, the private sector is hardly there from the various points of view. So there is a tightening of liquidity around. So we are also being cautious about how we proceed and move forward. My view, this will take another 2 to 3 months to ease out once the full impact of the budget is understood and what the government's thinking is understood. And there are also been some changes in government in some of the states. Some of the states are still going through some uncertainties. This will get settled down. So another 2 to 3 months, you should be okay, but you will find some little turbulence in between. Yeah.
And sir, I mean, although you said that you got more orders than you expected in Q1, what is the sort of target you're expecting in Q2? Do you think that whatever was blocked in Q1 the order inflow will make up for that in Q2, or will it take 2 more quarters to?
It's as good as me asking you whether it will rain tomorrow morning. It's very difficult to predict because you must appreciate we are dealing with large projects. And multiple drivers decide the award. So very difficult to predict, but all that I can mention to you is that there is always a pipeline of projects that did not get awarded in the previous quarter coming into the following quarter. And this cycle, we have over 80 years life, sort of managed it reasonably well, and we've been able to, barring few quarters where there is a degrowth, we've been able to hold this. Now, how far this process will go and how much of money government and PSUs will find to finance infrastructure, because that's where bulk of our orders come in. And the volatility in the order inflow is largely on account of those orders, infrastructure orders. So it's a function of how well prepared government is or the awarding agencies are in terms of awarding this. But it will be volatile. I did mention in the last meet of ours that unlike the previous year, it would be back-ended. We will see the growth of 10 to 12% playing out more in the later quarters, meaning quarter 3, maybe quarter 4. So quarter 1, we are trying our best, but it will be too early for me to point a number.
So, Andhra has been a very important state over the last 3-4 years. And what is your exposure in particular to that state? And are any of your orders getting reviewed by the new government? If you could give some information.
It's a general order passed by the state government of Andhra Pradesh. So few of our projects which are not reached 25% billing are also under review. These are basically residential projects. We have had discussions with them. It's come to a point where in a month or so there will be some resolvement of this. We have to wait for that.
How big is Andhra state in terms of order books, sir? If you could quantify it as a percentage?
It's out of 3 lakh crore, I think it is less than, the kind of hold that we have is less than say 3%.
Sir, one last question. You, of course, kept the order inflow guidance and the revenue guidance intact, but I'm sure there is a realization that it won't be just from the government orders. The private orders will also have to contribute more than what they have done in past. How do you see the private order space coming in for the current year? I mean, do you see what kind of improvement in terms of quality do you see from that space?
Do appreciate in the first quarter, just as statistics I'm telling you, 50% of the orders that we have won came from private sector. When I talk about private sector, airports are included. Now, the private sector, there are some buildings that is sponsored by private sector. campuses that are being built, logistics centers that are being built, data centers that are being built, and the airports that are being built. So out of 38,000 crores, 19,000 crores is from private sector. So in a manner, and there was also a cement factory order that we won. So in a manner of speaking, private sector has returned back to the chart. But if you want to talk on a more broader sense, are people going to add capacity? No, I don't see the conditions yet easing out for them to add capacity. If somebody adds capacity, they need to raise money. Is capital markets ready to provide money? We don't know. After the current budget announcement of taxing the capital market participants, the availability of liquidity in capital market cannot be taken for granted. Debt market is in shambles. Banks are running scared to take credit decisions. Questions are being asked about the wisdom of the past credit decisions. Please look at the entire environment, and private sector will think 10 times before they commit their capital for putting up a facility. So I think we should expect for the next 12 to 15 to 18 months of subdued private sector capital in a broad sense. There will always be exceptions. Some more airport orders will come that will be in private sector, perhaps. Some hospitals could come that could be in private sector. But by and large, I don't think it is fair to assume the industrial capex have returned, but selective non-industrial capex will continue to happen.
Okay. Thank you.
Good, thank you.
Excellent. Very good. Thank you.